Hello everyone, welcome to this video for Random Dimes. In Random Dimes, try to help you discover new alternative investment platforms. The goal is to help people understand this asset class. It's a new asset class for a lot of new people, so they can make more informed decisions. In this video, I have Neha Juneja with me, who is the founder of India P2P. She has been associated with many other startups and has a strong focus on sustainability. Thank you, Neha, for taking out some time from your busy schedule, and we have some questions for you. But before we ask those questions, I would want you to give a brief overview about what you have done, your entrepreneurial journey.
First of all, thank you for having me here. So I have not been associated with a lot of startups, just two startups. One, of course, is India P2P, and before that, another startup which still continues to run, which I ran for 12 years. And the thesis for India P2P also comes from there. So before India P2P, I used to run a clean cooking enterprise. A lot of people don't realize that about 3 billion people globally still cook on firewood or cow dung or crop residue. They might have access to LPG, even electricity based cooking, but because this fuel is cheap, they tend to cook on biomass as a fuel. And in my previous company, we developed cook stoves that burn the same fuel like biomass, etc., but burn it much more cleanly, have a very, kind of substantial climate impact as well. And the primary distribution channel we found globally, not just in India, to distribute or introduce a product like this was microfinance, which is women sitting in self-help groups or joint liability groups, discussing a problem, developing businesses, thereabouts. And we started doing this in about 2010, which is a fair bit of time ago, and had a kind of very clear view of what was happening in the microfinance industry. It's a very interesting industry, which because it depends on it's based on a very templatized borrowing behavior. It is the only industry which coaches and trains individuals over the long terms to be high quality borrowers. And when the opportunity for a peer-to-peer license came about, it just seemed like a really good opportunity to blend peer-to-peer lending, which brings in some fundamental market efficiencies to lending with microfinance. And that's how India P2P started out.
Great. So, how will you explain India P2P to someone who's new to investment?
Sure. So India P2P, we are simply a platform that helps you invest in the microfinance asset class. It means that you're investing in, first of all, unsecured loans. It is not to be treated at par with, an FTO that sometimes happens that people tend to treat because it's a debt investment. You start comparing it with an FT. No, definitely not. You are essentially investing in a portfolio of loan fractions, which with India P2P are going to microfinance borrowers. On other P2P platforms, they could be going to a different set of or type of borrowers. And the returns you make are fundamentally the interest earnings that you earn off these borrowers. For the borrowers, it's beneficial because this is another alternate and possibly a slightly cheaper source of capital. And but investors must, when we think about debt investments, we think that there is no risk, especially to the
Right.
principal. But I want to qualify with, investors, this better, but investors tend to think that sort of equity market में risk होता है, debt market में risk नहीं होता है. But I want to definitely put it on record here that since you are lending to individuals, there is definitely a risk of those individuals not paying on time or not paying at all, which can impact your principal as well.
In fact, I've been using India P2P for a long time. I mean, the returns have been pretty good. So that's why I thought this will help a lot of new investors to understand the platform better. So I think your experience in your last or your current organization, Green Grameen, would have helped you to understand the demographics, the kind of behavior which would have helped you in creating India P2P.
Oh, yes, absolutely. So I think we ended up working with a lot of microfinance operators, and over the years, came to this very solid understanding that this is a very scalable segment. A lot of people kind of disbelieve this statistic that I give them that India has about 80 million or 8 crore active borrowers as of now who have a CIBIL footprint. The entire microfinance industry has a CIBIL footprint. And over the 10 years, we kind of saw how a lot of the smaller microfinance operators ended up becoming banks, Bandhan Bank being,
Right.
the largest such example. Even if you look at the, IPO market or thereabouts, they've
Right.
just had huge commercial success. And such huge commercial successes, of course, doesn't always mean that the underlying asset class is great, but huge commercial success so consistently for so many microfinance players goes on to indicate that it's a very stable and high quality asset class composed primarily of women borrowers who have been coached and trained and kind of have self trained themselves to ensure that they never delay payments, default payments or thereabouts. But having said that, every asset class has its vulnerabilities. We also learned that over the years that let's say you have some sort of a climatic event in one part of the country, like what we're seeing in Chennai or AP right now. Our borrowers in those geographies, if we have any borrowers, would be impacted, which would impact repayments as well. Which is why this is also an asset class where it's important to distribute your capital across geographies, across income sources, types of businesses of the borrower and thereabouts. But the good thing is that technology lets you do that very easily and at no cost. So we can break an investment into small fractions, reconstitute it, and doing all of that pretty much has no cost once you have tech built out. So which is why the P2P model in microfinance also had this very beautiful advantage of high quality
Mhm.
diversification. And that was another kind of pull towards setting up India
Right.
P2P.
Actually, that brings me to a next question. So a lot of people, when they talk about fintech platforms, so they assume that those platforms just have a good front end, and through that front end, people are investing somewhere. But I understand there's a lot of risk management process, a due diligence process, which goes behind it, which a lot of people cannot see, and I think that separates maybe a good platform from an average platform. So, what is the risk management process followed by India P2P? Can you just run me through the life cycle of loan origination to risk management and your
Yes.
analytics?
First of all, starts at the loan origination, the point of loan origination. So we actually physically meet with each and every one of our borrowers. So I would like viewers here to understand that we're talking about high yield loans here. So these are borrowers who are paying 17, 18% plus interest rates, and that is the interest rate you want to earn as a lender. So and surprisingly, unsurprisingly, like most of microfinance industry has CIBIL scores.
Hmm.
So we have borrowers who could even have an 800 plus CIBIL. We have borrowers who could even have, the median CIBIL is around 720 or thereabouts. So they also have a CIBIL score. But the challenge remains is understanding the income of the borrower. Most of our borrowers are self-employed. Most Indians are self-employed. Like a majority of
Right.
Indians are self-employed, and you cannot you can collect a bunch of alternate data, which is something that we also do, but it still becomes very important to firmly understand the location and the business of the borrower. So which is why we only onboard borrowers in geographies where we have field teams. Our field teams meet each and every borrower.
Hmm.
They visit their home, they visit their place of work to kind of understand the asset base as well as the business profile, the income profile of the borrower, and only then are loans disbursed. And subsequently, once these loans come into our central database for every lender, of course, lenders can kind of choose to mix and match their portfolios or loans as well. But depending on the criteria the investor has set, the money is then allocated, diversified across geographies,
Hmm.
business type of the borrowers, and eight such parameters to ensure that it's not just diversity across X number of loans, but it is intelligently diverse, keeping in mind some of the unique risks that are there in this asset class, and also like general risk which exist in any borrower category.
I think one interesting point which you highlighted is that there's a lot of you meet the borrowers, you know them personally, or there's interaction between the borrowers and the lender, which I think a lot of platforms do not have that model. I mean, a lot of BNPL based P2P lending, it's just totally based on some score created by an algorithm. So I think knowing the borrower that gives a lot of more information which cannot be directly taken out from some online database. I think that's a good point.
There's another thing. So what happens is that India is a market where it's quite easy to sell loans.
Hmm.
Like there's like a statement in the industry that India में सबको loan चाहिए.
Correct.
चाहे वो अमीर हो गरीब हो, it really doesn't matter. It's a market where it's
Right.
lending or giving out loans is not difficult. And one of the kind of also important reasons why we meet borrowers in person is to ensure that the borrower understands their obligation towards the lender, which is retail lenders on this side. Retail investor capital is perhaps the most precious type of capital that any platform can assist in investing. And आप ऐसे मान के चलिए that let's say I am Neha, of course I am Neha. I've taken two loans, one from a digital lender and one from India P2P, where I know that India P2P has this little office with some 5-6 people, and they're about 5-7 kilometers away from me. If I'm in one is that I remember, like I'm serious about that loan because this person came to me in person, met me. If I have business partners, met my business partners as well. If I have any sort of distress in repayment, I'm less likely to default on a loan where I know that these folks are close to me, and they could always come and check what's up, etc., etc. And just knowing that also kind of instills that discipline, which may seem harsh when we put it out here, but it is a very effective mechanism in just ensuring good discipline. I'm not
Right.
talking about any naughty tactics to collect. I'm just talking about just a good discipline mechanism.
In fact, I think all the successful NBFCs or microfinance companies which are in this sector, I mean, they do have a physical presence or some way to connect with the borrower rather than just through a digital mechanism. I think, and that is especially in this sector or in this particular category, it's a must. I think that's important. Hmm. And how do you describe your borrower profile? What kind of people are these borrowers? What are the demographics? What geographies or they're distributed across India? What ticket size generally they look for? And what is the requirement of these loans?
So by and large, the loans are business loans, and the borrowers we cater to are women with a civil score,
Mm.
with an overlap of small business owners. Small business owners are also very interesting category of borrowers on two fronts. One is because, I mean, they have genuine business need, and also small business owners generally understand the fact that their credit needs or their need for a loan is ongoing. So if they kind of break the cycle of good repayment behavior now, I mean, their future requirements also get impacted. So that understanding is a little more better ingrained than some of the other borrower categories. And by and large, about 80-90% of our borrowers fall in the overlap of these two, which is essentially women, small business owners. And almost all of our borrowers have taken a loan before, typically from a bank or another NBFC. They have a CIBIL score, but their borrowings are typically small, is why it's not easy. Like, banks don't
Mm.
like to give out a 40-50,000 rupee loan. It's too
Mm.
expensive for them to do that, which is why they rely on operators like us for their
Mm.
credit needs. So the average borrowing would be between 40 to 50,000, and our borrowers are all the way starting east from Nagaland to covering all the five southern states, a little bit of central India, and Maharashtra. We are less present because we need our people to be present wherever we lend,
Mm.
less present in the northern part of the country.
So I think one question a lot of people ask is, how does India P2P achieve 16% return when banks are giving 7-8%? Maybe these
Hmm.
NBAs, microfinance institutions are giving 10-12%. How does India P2P end up making so much returns for the clients? So could you explain how the P2P mechanism and how India P2P is able to deliver such high returns?
I don't. So this is a fundamental kind of design principle of the P2P model where you essentially bypass intermediaries.
Mhm.
Like when a bank gives you 7-8% return, bank is further lending it at least a 3-4% yield higher, or they're adding at least 3-4% on it. And unfortunately or fortunately, I would rather say unfortunately, the credit value chain in India is very lopsided. We have about close to 10,000 NBFCs in India,
Mm-hmm.
and less than 500 of those would be upwards of 1,000 crores
Mm-hmm.
in AUM, and very few in double digits, not even triple digits. Like not even 100 of them would be rated A and above. And most of the capital is kind of first goes to these very few number of NBFCs, we call wholesale NBFCs, or some very large NBFCs. Then it trickles down to a smaller NBFC, so another 3-4-5% is added.
Mm-hmm.
Then maybe to another one, so another 3-4-5% is added, and then finally to small borrowers. And microfinance is of course small borrowers. I mean, it's in the name. So what is happening in the microfinance industry is that the borrower is paying 18% to 24%, or sometimes even higher, which is like the industry standard. Till some time ago, the interest rates in microfinance were also regulated. In the sector were regulated, but of course different players had some flexibility. And so the borrowers are paying a high interest rate already, but the investors, because there are so many middlemen in between, are earning less. So
Mm-hmm.
we are not going as India P2P going after high risk borrowers. We are just going after the standard, microfinance borrower. But because there are no middlemen in between, is why investors are earning a higher yield. And like I said, we are not going after new to credit borrowers or borrowers who are in any kind of distress. These are very clean CIBIL score holding borrowers with past borrowings. On average, an India P2P borrower has been running the same business for 8 years, for which she is borrowing again. So that is telling something. But essentially the returns are coming by eliminating a bunch of the middlemen who exist in this credit value chain, particularly in the borrower segment that we are talking about.
That's why we see, if you see the net interest margin of a lot of these NBFCs, you see that they make significant returns between the cost of borrowing and the rates they're lending at to these
Like
borrowers.
for a small NBFC also today, the cost of borrowing could be 16, 17%.
Mhm.
It's not unusual to see that kind of for an NBFC. We're not talking about the borrower.
And but then they
It's
will
very
target a more higher risk borrower to achieve profitability.
absolutely, absolutely.
So I think if we compare the risk and returns, India P2P is delivering around 16% returns. So if someone has to compare a similar asset which provide returns comparable to India P2P, then they have to look at something like a venture debt or a real estate back NCD, because the conventional NCDs or the bank FDs bonds, they just deliver around 9 to 11%. So then how is the risk profile maybe of India P2P if you compare to maybe a venture debt or real estate debt, because these are the assets which are offering similar returns. So if investors have to choose between the three, so how where will India P2P's risk lie in comparison to these?
Well, what I would say is that there is peer-to-peer lending. It's difficult to compare apples to apples these risks, and like you also recommend to your readers, it is just very important to diversify.
Right,
It's just important. Like that is
right,
the only thing closest to a free lunch in the financial markets. But I would say that in peer-to-peer lending, one has to understand that all of the loans are, in our case, in every microfinance lender's case, the loans are unsecured.
right.
If you have an impact like COVID or something even similar to COVID happening, the impact on your India P2P investment could be a lot higher than what it could be in a real estate NCD.
Mhm.
In some scenarios, it's quite likely to happen that ways.
And
So
I
that's
think
why
one of the factors is the ticket size also, because you end up at least investing maybe 1 lakh in one NCD. So for diversification, you would need a lot many NCDs or lot much
correct,
capital
correct.
to get the same kind of diversification which you get through P2P lending, because by design it has that diversification inbuilt.
Yes, and that's the thing. So in a, I would say that in a scenario, in a kind of normal, when the economy is running well,
Mm,
everything, there are no extenuating
mm,
circumstances in any one part of the country
mm,
where one might have borrowers. your risk is mitigated in P2P lending. Your risk is mitigated to such a granular extent by distributing your capital across loan fractions. You are
Hmm.
not exposed to any one geography, any one borrower, anyone, um, overexposed to any one borrower and thereabouts, which is the beauty of tech coming into play here. But having said that, sometimes there is a perception that there is some security that is taken from the borrowers in P2P loans and thereabouts, which is incorrect. In fact, the P2P lending is regulated by the Reserve Bank of India, which also adds some, kind of safety for investors in this, or at least confidence for investors in P2P lending. And RBI compliance also do not permit taking any collateral for these loans.
In fact, like now you mentioning about RBI and regulatory, they monitor these kind of platforms. So a lot of people they've been talking about the asset liability mismatch because how some platforms they provide instant liquidity. But how does India P2P works? I mean, do they also have, do they also can face a ALM problem, or each borrower is mapped to an investor, so that problem should not arise for India P2P? So
So first of all, we don't offer instant liquidity. We have a pretty hard 1 year lock-in, which
right.
also ties into the fact that our average loan tenures are a little bit on the higher side. And of course, every loan is mapped to every lender.
Hmm.
So there is no uncertainty as to where your returns, which borrowers your returns are coming from, and where your capital has been allocated to. And fundamentally, you can have a very short term investment product on peer to peer lending as well, but that would essentially imply that you're giving out very short term loans also.
Hmm.
And
Does not
very
mean
short
that you
term
are
loans.
running it like an NBFC where you're managing some cash or putting it in escrow, but it's the nature of the borrower which will define the kind of tenor the investment will have.
Yes, so you cannot. It's like mathematically, it's very hard. कि अगर आप 2 साल का loan दे रहे हैं and you have only a 2 month lock
Right.
in on this side, that is very hard to manage. So it has to be, and I believe most platforms do this as well, which
Hmm.
is giving, doing some like estimation of their cash flow timings or the
Hmm.
cash movement timing, so to say,
Hmm.
for ALM purposes.
So I think there's a question. Some of the readers had that they would want to put more capital, deploy more capital in India P2P, but they say okay, because right now we would only want to invest a certain sum of money because we want to find the right borrowers. So what is your take on that? Probably maybe in future people will be able to deploy more capital more quickly, or you would want to be more sure about the kind of borrower you're doing, and rather wait and deploy.
So, Rohan, like I said, we physically meet and verify each and every one of our borrowers. And this kind of meeting and verification is also not done by random individuals.
Right.
So, the team that we have in every geography is a team that comes with some banking experience, lending experience in the past, collections experience, etc. So it does take us some time to scale up in different parts of the country, and which is why at India P2P we cannot suddenly absorb 3x the capital we absorbed
Right.
last month. So it's a very paced process, and right now for as we are growing, enough capital has been coming in, so
Hmm.
where we feel grateful and fortunate for that happening. But at no stage do we want to dilute this process, which we believe really kind of like adds to the credibility of the borrower base or the loans that we are sourcing.
Great. It was great talking to you, Neha. I think a lot of our readers would have found it really helpful. They would have a lot of questions in mind about what India P2 does, how it manages risk. I think this will help them making an informed decision before investing, before taking the next step. I would thank you for taking out time, and all the best for India P2P.
Thank you, Rohan. Thank you.